Have you ever wondered what it would feel like to see a financial crisis coming before it destroys your savings? To have a plan in place while everyone else around you panics? That's exactly what one man, Ray Dalio, did not just once, but multiple times over the last few decades. And today, I'm going to show you how his strategy can help you protect, even grow your money when the economy looks like it's falling apart. Before we dive into these secrets, let me tell you a quick story. In 2008, when the world faced the worst financial meltdown since the Great Depression, banks collapsed, millions of people lost their jobs, and entire economies seemed on the verge of disaster. But one investor wasn't surprised. He had been preparing for years. His name, Ray Dalio. Ray isn't just another Wall Street guy. He's the founder of Bridgewater Associates, the world's largest hedge fund, and the creator of the idea that the economy works like a machine. For him, every part credit, interest rates, jobs fits together in predictable cycles. And if you know how to read those cycles, you can predict booms and busts with shocking accuracy. In this video, you'll learn the core of Ray Dalio's strategy, his famous principles for making clear-headed decisions, and the debt cycle that allowed him to anticipate some of the biggest market crashes in modern history. This isn't a get-rich-quick scheme. It's a practical roadmap that will help you understand how the economy really works and how you can protect yourself before the next storm hits. And the best part? You, Dan T, need to be a billionaire or have an Ivy League degree to apply these ideas starting today. But first, why do central banks, billionaires, and governments around the world seek Ray Dalio's advice? You'll find out in the next 3 minutes. Don't go anywhere. To truly understand how Ray Dalio became one of the world's most influential investors, you have to look back at the events that shaped his life and the lessons he learned from both his biggest wins and most painful losses. Because Dalio's story isn't about someone who got lucky. As about someone who spent decades studying the patterns that make the economy tick and used that knowledge to build one of the most successful hedge funds in history. Ray Dalio was born in 1949 in Queens, New York. His father was a jazz musician who played the clarinet and saxophone in Manhattan nightclubs, while his mother stayed home to raise him. There was nothing privileged about his upbringing. No wealthy relatives, no prep schools, no family connections on Wall Street. What he did have was curiosity and a drive to understand how money worked. He got his first taste of the financial world as a teenager, when he worked as a caddie at the Links Golf Club, a course frequented by Wall Street executives. As he carried their golf bags, he overheard them discussing the stock market. One day, intrigued, he decided to buy his first stock, Northeast Airlines, investing $300 he'd saved up. That stock tripled in value after a merger was announced, and young Ray was hooked. He realized markets weren't just random, they followed patterns. And if you could read those patterns, you could make money even as a kid. While many teenagers focused on school dances or sports, Dalio spent his time reading annual reports, studying market charts, and trying to connect economic events with price movements. He became obsessed with finding cause and effect relationships in the market. By the time he graduated high school, he knew he wanted to dedicate his life to understanding markets. Dalio went on to earn a degree in finance from Long Island University, then an MBA from Harvard Business School. At Harvard, he stood out for his willingness to challenge conventional wisdom, debating professors and classmates on how markets worked. After graduating, he worked as a trader at Dominick & Dominick LLC, and later at Shearson Hayden Stone, where he developed his early investment theories. But it was in 1975 that his real journey began, when he founded Bridgewater Associates from his 2-bedroom apartment in New York City. At first, Bridgewater wasn't the giant it is today. Dalio started by writing daily economic reports for corporate clients. One of his first major customers was McDonald's, which needed help managing foreign currency exposure as it expanded internationally. Dalio's detailed analysis impressed them, and word spread quickly on Wall Street about his unique insights. This small research business laid the foundation for what would become the world's largest hedge fund. But Dalio's path wasn't a straight line of success. In 1982, convinced the U.S. was heading for another Great Depression, he made a series of aggressive, bearish bets. He was so sure of his prediction that he publicly debated economic leaders and called for a massive economic downturn. When the economy instead recovered strongly, Dalio's positions blew up. He lost nearly everything he had to lay off his entire staff and borrow money from his father just to keep the lights on. This humiliating failure could have ended his career. Instead, it became the catalyst for his most important breakthrough. He realized that it wasn't enough to be smart or even to be right. Sometimes you needed a systematic way to think. Test your assumptions and challenge your own beliefs. That's when he began developing what would become his life's work, his principles. These were rules for making decisions rationally, managing risk, and learning from mistakes, not just in investing, but in every part of life. Dalio also began building a culture of radical transparency at Bridgewater. He wanted his employees to challenge him and each other without fear. Mistakes weren't hidden. They were dissected openly so everyone could learn. Meetings were recorded so anyone could see what was said and why decisions were made. This culture helped Bridgewater avoid groupthink and adapt quickly when markets changed. As Dalio refined his approach, Bridgewater's reputation grew. The fund began attracting major institutional investors like pension funds, university endowments, and sovereign wealth funds. By the 1990s, Bridgewater's flagship fund, Pure Alpha, was delivering consistent double-digit returns, often outperforming the broader market by wide margins. Dalio's fame reached new heights after he accurately predicted the 2008 financial crisis. He had been warning for years that rising household debt levels and risky mortgage practices would end in disaster. When the housing bubble popped, Bridgewater's funds made massive gains while many of the world's biggest banks collapsed. Dalio's reputation as an economic oracle was cemented. But Dalio never kept his ideas a secret. He published his research in essays and later in his best-selling books, including Principles, Life and Work, and Principles for Navigating Big Debt Crises. He also released a 30-minute animated video, How the Economic Machine Works, simplifying his ideas so anyone could understand why economies boom, bust, and recover. That video has since been viewed over 25 million times and translated into dozens of languages. Today, Bridgewater manages over $150 billion in assets, making it the world's largest hedge fund. And he's donated hundreds of millions to educational initiatives to help people learn how the economy really works. Curiosity, humility in the face of mistakes, and a systematic way of thinking about markets that challenged everything the traditional financial world believed. Dalio's influence extends beyond investing. He has advised central banks, world leaders, and governments on how to navigate economic challenges. Dalio's journey from a teenage caddie to a billionaire investor wasn't fueled by luck or connections. It was built on relentless and how these tools can change the way you invest forever. But how exactly did Dalio transform his insights into a strategy that could predict crises years in advance and help you prepare for them too? In the next section, I'll reveal the debt cycle model he developed, the principles he uses to guide every decision. Now that you know how Ray Dalio built his understanding of the economy, it's time to dive into the heart of his strategy, the debt cycle and the powerful principles he uses to navigate markets. These are the tools that helped him predict crises like 2008. They can help you make smarter investment decisions too. Dalio's most important insight is that the economy doesn't move randomly. It follows predictable cycles driven by human nature, greed, fear, and the constant push to borrow and spend beyond our means. By tracking these cycles, Dalio realized you can anticipate when markets are overheating and when opportunities to buy at bargain prices appear. He describes two types of debt cycles. Short-term debt cycles, which last 5 to 8 years and make up the booms and recessions we see more often. Long-term debt cycles, which take 50 to 75 years to complete and lead to massive system-wide resets when they peak. Here's how it works. During the short-term cycle, as the economy grows, businesses borrow more to expand. Consumers take out loans to buy homes, cars, and other goods, and spending increases. This creates a positive feedback loop. More spending leads to more profits for businesses, which hire more people, who then spend more. Asset prices rise, people feel richer, and the cycle continues. But eventually, debt grows faster than income. People and companies start struggling to make payments, defaults rise, and lenders tighten credit. Spending slows, corporate profits fall, layoffs increase, and a recession begins. At this point, central banks typically cut interest rates to make borrowing cheaper, which stimulates spending and kicks off the next short-term cycle. This pattern repeats multiple times within a long-term debt cycle, which is more dangerous because, over decades, each short-term cycle adds more debt to the economy. As the long-term cycle nears its end, debt reaches such high levels that cutting interest rates isn't enough anymore because rates are already near zero. When that happens, the economy enters a deleveraging phase, which can only end in a few ways. 1. Spending cuts, which usually cause painful recessions. 2. Defaults or debt restructuring, where debts are reduced or forgiven. 3. Massive money printing by central banks, which can lead to inflation or currency devaluation. Dalio says the way policymakers choose among these options determines how smoother, how disastrous the deleveraging will be. And by watching these choices, you can anticipate what will happen next in the economy. To make this practical, Dalio uses what he calls principles rules. He and his team follow to make decisions without letting emotions get in the way. Here are a few of his most powerful principles. Pain plus reflection equals progress. Dalio believes every mistake, loss, or painful experience is a chance to learn and improve. After every big error, he and his team analyze what went wrong, write it down, and adjust their decision-making process to avoid repeating the mistake. This is a core reason Bridgewater adapts faster than many competitors. Radical truth and radical transparency at Bridgewater. Team members are expected to challenge each other's ideas directly and honestly. Meetings are recorded so everyone can review how decisions are made. Employees rate each other on their thinking in real time. This radical transparency creates a culture where the best ideas win, not the loudest voices. Believability-weighted decision-making. Dalio doesn't make decisions alone or by majority vote. Instead, he assigns credibility scores to his team based on past accuracy and expertise in each topic. People with proven track records in specific areas have more weight in decisions on those topics. This helps avoid the traps of hierarchy or office politics that can derail organizations. Now, let's see how Dalio applied these ideas in the real world. In the early 2000s, Dalio watched household debt-to-income ratios climb to historic highs. He tracked adjustable-rate mortgages and noticed banks approving loans for people who clearly couldn't afford them if interest rates rose. Using his debt cycle model, he recognized the U.S. was at the peak of a short-term cycle and dangerously close to the end of a long-term cycle. While many experts and government officials said the economy was healthy, Dalio warned clients that a major correction was coming. When the subprime mortgage crisis triggered the collapse of financial institutions in 2008, Bridgewater's funds made significant profits while many other firms went bankrupt. Dalio's debt cycle model wasn't just a theory, it was a tool that saved billions for his investors. Another key piece of Dalio's method is his all-weather portfolio and investment strategy designed to perform reasonably well in any economic environment. Dalio realized most portfolios were built on the assumption that the future would look like the recent past. But markets change dramatically when inflation spikes or recessions hit. So he created a portfolio with a mix of assets that react differently to the four main economic scenarios: growth with low inflation, recession with low inflation, growth with high inflation, recession with high inflation. For example, stocks do well in growth environments. Long-term bonds protect during deflationary recessions. Commodities and gold help when inflation rises, and a diversified mix reduces the risk of any single scenario wiping you out. Dalio's backtest showed this approach significantly reduced volatility and drawdowns, while delivering solid long-term returns, proving that thoughtful diversification can help you weather any economic storm. But how do you apply these concepts to your own investments if you, Dante, manage billions of dollars? I'll show you step by step how to build your own all-weather portfolio, how to track where we are in the debt cycle, and how to make smarter decisions no matter what the economy throws your way. In the next section, now that you know how Ray Dalio reads the economy and creates strategies to protect wealth, let's talk about how you can start putting these ideas into action right now, even if you don't have millions to invest. Because the truth is, Dalio's method isn't reserved for billionaires. It's a mindset and framework anyone can use. First, let's build your own version of Dalio's all-weather portfolio. Remember, the goal isn't to predict what the economy will do next, but to be prepared for anything it throws your way: growth, recession, inflation, or deflation. A simple starting point for you. Based investors could look like this. 30% stocks. Choose a broad market. ETF like SPY or VOO for exposure to the S&P 500. 40% long-term bonds. Use an ETF like TLT, which holds long-dated U.S. Treasuries that tend to perform well during deflation or recessions. 15% gold. A fund like GLD or physical bullion helps hedge against inflation and currency devaluation. 15% commodities. An ETF like DBC gives exposure to energy, metals, and agricultural commodities, which can outperform when inflation spikes. This mix gives you exposure to assets that generally move in different directions depending on economic conditions, helping you avoid the trap of betting everything on one outcome. Now, how do you know when it's time to adjust your portfolio? That's where understanding where we are in the debt cycle comes in. Dalio recommends tracking key economic indicators to get clues about whether the economy is overheating or slowing down. Some of the most important data points you can watch are debt-to-income ratios. Rising debt levels faster than income growth signal the economy may be near the peak of a short-term cycle. Interest rates. Very low rates for a long time mean the economy could be nearing the end of a long-term debt cycle, where traditional monetary policy loses effectiveness. Inflation trends. If inflation starts rising quickly, assets like bonds can suffer, while commodities and real assets can shine. You don't have to be an economist to access this data. Websites like the Federal Reserve's FRED database, the Bureau of Economic Analysis, or even financial news outlets like CNBC and Bloomberg offer free charts and updates. By checking these indicators a few times a year, you can get a sense of whether your portfolio's balance still makes sense or needs small adjustments. Another practical step is to use backtesting. Dalio and his team at Bridgewater test their strategies against decades of historical data to see how they would have performed during past crises. You can do something similar on a smaller scale with free or low-cost tools like Portfolio Visualizer or even Excel. For example, download monthly price data for SPY, TLT, GLD, and DBC. Run a simulation to see how your portfolio would have performed during past events, like the 2008 financial crisis or the 2020 COVID crash. Adjust allocations if you see your portfolio would have suffered more than you're comfortable with. But remember Dalio's most important principle: don't let emotions drive your investment decisions. If markets fall and panic sets in, your diversified portfolio is designed to protect you. Selling in fear locks in losses, while sticking to your plan allows your strategy to do its job. To make this easier, keep an investment journal. Every time you make an investment decision, buying, selling, rebalancing, write down why you did it, what you were feeling, and what indicators you were looking at. Review it regularly to spot patterns in your thinking that lead to good or bad outcomes. This reflective process is at the heart of Dalio's pain plus reflection equals progress principle. And don't forget about radical transparency, even if you're investing alone. Share your portfolio ideas with a friend or mentor you trust. Invite them to question your assumptions and challenge your blind spots. It's amazing how much clearer your thinking becomes when you have to explain your reasoning to someone else. Most importantly, start small. You don't need tens of thousands of dollars to begin building an all-weather portfolio, with many brokerages offering fractional shares. You can start with as little as $50 or $100 and gradually build up as you get more comfortable. By combining smart diversification with regular check-ins on where the economy stands in the debt cycle, you'll be better prepared than most investors who chase hot trends or follow gut feelings. You won't be able to predict every twist and turn, but you'll have a plan designed to survive and thrive across the full range of economic possibilities. But how did Dalio actually see the 2008 financial crisis coming in such detail? And what are the same indicators telling us about today's economy in 2024? In the final part of this video, I'll break it all down for you so you can spot the signs of an approaching crisis before it's too late. Congratulations on making it to the end of this video, because by staying with me until now, you've already set yourself apart from most investors who never take the time to truly understand how markets work. You've learned that the economy isn't a random walk. It follows cycles that repeat over and over again because human nature or tendency toward greed and fear ever changes. You now know how Ray Dalio uses the debt cycle to read the economy like a clock, spotting when it's time to take risks and when it's time to protect capital. You've discovered his principles, which help you avoid emotional decisions and think with clarity even when everyone else is panicking. And you've seen how to build your own all-weather portfolio so you, Dan, need to guess what the economy will do next because you'll be ready for anything. This is the mindset that has made Ray Dalio one of the most respected investors in history, and it can make you a smarter, more resilient investor too. Because crises will always come. They're part of the natural economic cycle. But whether those crises wipe you out or give you a chance to build real wealth depends on whether you prepare before they happen. But here's the thing. What if I told you the same debt cycle indicators that helped Dalio see the 2008 crash are now flashing warning signs again? What if I told you we're seeing record levels of debt, extreme monetary policy, and inflationary pressures that look eerily similar to the final stages of a long-term debt cycle? Could we be heading for another major economic reset? In my next video, I'll show you exactly how Dalio's model predicted the 2008 financial crisis step by step, what it's telling us about the risks facing the global economy in 2024. You'll learn which indicators to watch, how to read them, and what practical steps you can take right now to protect your savings and take advantage of the opportunities that crises always bring. So if you don't want to miss it, hit the subscribe button and turn on notifications so you be the first to know when the video goes live. And if you like a free checklist with Ray Dalio's top principles to guide your investment strategy, drop a comment saying Dalio Principles and I'll send it your way. If you found this video helpful, give it a thumbs up. It helps more people find this information, and share it with a friend who needs to stop investing blindly and start investing wisely. Remember, knowledge isn't power until you use it. Thank you for watching, and I'll see you in the next video where we'll dive even deeper into how to predict and survive the next big financial storm. Subscribe and turn on notifications for part 2. Want Dalio's principles? Comment Dalio Principles below. Like, share, subscribe.